in the county. And hopefully this this conversation today, and I want to be a conversation and not so much of a presentation. Hopefully this will be valuable and have some good information for everyone.
Perfect. And so thank you, Bill and Chris, for taking your time to join us. I also wanted to let all the business owners on the call know that we also have joining us Davis Warnell with Senator Kelly Loeffler's office. So I'm going to turn it over to Davis now just to introduce himself. But he has joined the call to hear the concerns of small businesses and what's facing them right now so that he can take it back to the senator and get you guys some answers on any financial questions that you might have. So Davis, if you're on the call, if you could introduce yourself.
Yeah, like Alex said, I work for the office of Senator Kelly Loeffler, not the campaign. It's that time of year where I have to differentiate between the two. But yeah, my main objective here is to listen, hear the concerns that y'all have, and then I'm going to take those back to our legislative team, especially if there's any specific questions that I can answer. I'm going to take those back to our legislative team. And, you know, they're the real experts on the policy, and, you know, kind of they're the ones that get down in the weeds with this. And so I'm going to try and get y'all some concrete answers and get y'all some responses there. But like I said, my main objective is to listen and then get those answers to the legislative team and see what kind of answers I can get y'all from there. Thank you.
Perfect. And thank you, Davis. And so if you do have a question and you would like a response from the senator's team, when you ask the question, just make sure that you announce your name, and I will get Davis your contact information for the senator's office to respond back to you. So without any further introductions, I'm going to turn it over to Bill and start sharing our presentation. And we'll see what we can do to help some small businesses today.
Great. Well, thank you, Alex. And while Alex is pulling up our slides, I do want to say that Chris and I both have been through multiple recessions. Certainly this one is a little bit unique, but we thought the topic small business banking in a pandemic is something that is very much on everyone's minds. If it's not PPP loans or EIDL loans, it's PPP loan forgiveness, where we don't have all the answers and we won't pretend to, but we do want to talk a little bit about how does a business owner really navigate through a pandemic. If this is your first recession, hopefully this content will be valuable. Go ahead and go to the next slide, Alex, because we want to try to, again, as Alex stated earlier, make this as interactive as possible. So please, if we're on a particular topic and you have a question, please chat that question in, and then we'll take some breaks, answer the questions. We do want to make this as interactive as possible. And this presentation is for you. So please don't be bashful about asking hard questions. We'll do our best to answer them. So there's a great book out there written by Doug Tatum called No Man's Land. It probably describes what many of you are feeling right now. You can't talk up because there's nobody above you in your organization if you're the business owner. And you can't talk down because you don't air your issues in front of your coworkers. It's not good for morale. So you as a business owner, you're in no man's land. The book goes on to explain the 5 M's. The first M that the book talks about is momentum. Very likely when the economy hit a tree, you've lost momentum. Now you're trying to find it again. And for many of you, you may have found it. Hopefully it won't be short-lived, but you may be in a fight against the coronavirus, and it may be the fight of your life. Maybe you've never been here before. You're confused. You're frustrated. You know, maybe you're even scared. And so you just don't know where to start or what to do. Thank goodness there was PPP loans. Chris is going to take you through the next slide. So Alex, next slide, please.
So I think a lot of us through this pandemic and over the last, since February, March timeframe, if you're like me, there's a few phrases that you're almost kind of tired of hearing or wish you didn't hear again. And probably new normal for me is one of them. But unfortunately, it's a very good descriptive word. The other phrase is unprecedented times, and I heard somebody say they're looking forward to the day that we can be back into precedented times, where we're back into some sort of sense of normalcy. But if we go back, from that March, April, and even May timeframe, is there was just this somewhat collaborative effort between governments, between our government and our banks, to establish the PPP loans and EIDL loans. And I really think that those were more of lifelines that were extended, meant to be a temporary bridge to get us over. Really at that time was an undetermined time frame. We didn't know the duration. We didn't know the depth of what the shutdown was going to mean. But we knew something had to be done. And interwoven in this, some banks, most banks, I think, were also offering loan deferments, both on commercial and personal loans. And fortunately, the regulators gave banks some pretty good latitude, at least for 90 days, to handle those. So really, those were tools that were deployed, at least in the near term, on an emergency basis, to really serve as lifelines. Unfortunately, I think we're past that, and now we're coming into a time frame where where PPP funds have been utilized. We're now going into the forgiveness phase, which is a complex navigation route for small businesses and for the lenders. And we're also challenged with how do we deal with borrowers who are in need of a second deferment. There's not quite as much latitude given to banks from regulators when it comes to those loans. And so I think everybody's kind of challenged a little bit with the appropriately accommodate borrowers, but at the same time, stay within regulatory guidelines. I do think, to put things into perspective, I think we're fortunate in Georgia, compared to maybe our other peer states, maybe outside the region. Georgia, by and large, I think was one of the last to shut down and one of the first ones to reopen. I know in some segments, it doesn't really feel that way. Certainly some industries have been hit much harder than others, and that shutdown or that diminished capacity is continuing. And I think it's those businesses and those industries that are getting the most attention right now. All right, Alex, if you want to go on the next slide.
Yeah, so there were really a lot of issues with COVID-19. You've probably reached out to your advisor for help or advisors. Maybe you're misaligned with your market. Very possibly you've needed a pivot or you have pivoted. Maybe you've got the wrong business model and you need to change. A la the restaurant industry, they totally went curbside or takeout. Maybe you've had to lay off some people and you need to fill some key spots in management now. Whatever your problem is, you probably need a guide. And that guide walks through you. Again, back to my earlier point, no man's land, it's lonely at the top. And it's really not just any guide, but it's really a guide with a plan. And that plan really needs to include some very important things. Let's go to the next slide, Alex. So I want to tell you a little bit of a story, and we'll be taking a break after this slide to take questions. So if you do have some questions, please chat those in. I'm going to tell you a little bit of a story about a professional practice that I've been working with for several years now. So they have 3 locations, but their most profitable segment of their business was face-to-face. Sales dropped 20%. Gross margin dropped 10 points. Expenses were creeping up. the boat was taking in water and we had to plug the leaks. So this client got both a PPP loan and an EIDL loan, but she had to make a plan of how to provide services remotely. And even further, because the face-to-face piece went away entirely, she was unable to do that piece remotely. That's really what caused the 10% margin drop. So she had to do 30% more in revenue than she had before just to break even. And so what we ended up doing is making a plan first to provide services remotely, just to be sure she had revenue coming in. The next thing is we had to focus on collecting AR and collecting from insurance companies that are, because this was a professional practice that had insurance reimbursement. So being able to collect money from insurance companies is hard enough. During a pandemic, it's probably harder. And we also had to make a plan on how to build cash reserves, which it's hard to build cash reserves when the boat's taking in water. But to kind of give you a current status report, business is starting to increase up in terms of sales. She has been able to set aside some cash. The PPP loan and the EIDL loans were incredibly helpful to her in terms of how to have cash flow available to make payroll. Hopefully her PPP loan will be forgiven. And so we've plugged the leaks. I think we're starting to bail the water out of the boat. I think we've stopped taking in water. Now it's just a matter of how do we not only survive, but how do we get this business to thrive? These are some of the things that we did in this situation to help get her business to where she was stable. She was in survival mode, and now we're really working on figuring out how we can make it thrive. And we're going to stop at this point. Again, want to make this as interactive as possible for you. And so please chat in some questions, and Chris and I will give it our best shot to answer them.
And absolutely. So everyone, please feel free to chat in some questions. And if you want specifically to ask either Chris or Bill, if you make note of that, we'll be more than happy to. So we've got a question from Alan Najar here. It says, while banks are typically the cheapest option for borrowing other than PPP, the reality of COVID-19 is that a number of companies will no longer qualify for bank debt. What options are out there? And I think we're going to touch on this a little bit later, but if one of y'all wants to take a stab at it.
Chris, you want to go first and I'll chime in?
Yeah, that'll be great. We do have a slide because I do think, Alan, you raised an important question. So I think we're going to spend a little bit more time on that later on in the presentation. But really just kind of touch. That was kind of one of the slides that I thought was important to put into this because you're right. There is some, I wouldn't say a credit crunch yet, but there's certainly some tightening within banks. I think we're having to view things through a different lens. And, the other options, I think small businesses need to be open-minded to when they talk to banks. We're going to talk about venture capital. Venture capital can look like a couple different things. For larger companies, there's investment companies out there that takes on one element. I view venture capital as also being friends and family. Kind of the old-fashioned bootstraps, going to your friends and family and asking for an investment into the company. And then there's also hard money lenders, which generally they won't take the equity stake, but there is there's obviously a higher interest rate. And sometimes that can be an avenue. The other options that I think it just takes an open mind and a good conversation with your bank is looking at SBA as an option. There's also some non-traditional financing out there, invoice factoring, discount factoring, particularly for any company that carries receivables, can also be a good solution. You can see that provided by both banks, and you can see that provided by by factoring companies who specialize in that. There are options out there. It's not going to be the traditional lower interest rates that banks are willing to offer. But honestly, if you do your investigation, you have honest conversations with your bank, and then ultimately with that provider, it can serve a very needed purpose, particularly in times like this.
Yeah, Alan, the only other thing I would add, Chris gave you a good list. I have clients that are looking into grants. So the other thing is, if bank debt isn't available, there are some firms. City of Atlanta has the Resurgence Fund that is doing grant money up to $40,000 to handle non-PPP expenses related to COVID. I'm sure there are other programs out there, but I'm familiar with that one. So certainly checking into grants. Then I'll also echo, if the loan won't work on a conventional basis with the bank, SBA is an option. I'm actually working on 2 SBA loans with clients right now. And the 75% guarantee is not a piece of collateral, but it does mitigate some of the risks the bank might be taking that the SBA guarantee can provide some support. So I'd say grants and SBA loans would be the 2 I would hold up. Alex, other questions?
Yeah, and we have one more question from Jim. And Jim, I think your question is going to be one that a lot of people are going to be asking, and it'll be one that if any other business owner would like a direct answer from the senator's office, just send me your name in the chat box, and I'll make sure to add you to the list when they give a response. But it's in regard to the forgiveness of PPP and EIDL. And he's just saying that he's a small single member LLC, and he wants to know if there's any update on PPP and EIDL forgiveness. He wants to be clear of the debt as soon as possible. Jim, I believe you also were trying to figure out how to get rid of the EIDL actual loan and just focus on the grant and PPP money as well. So if you guys have any insight on this, if not, I will give this question directly to Davis, and we'll get Jim an answer from the senator's office.
Yeah, I'll take.
I'll
go ahead, Chris.
Go ahead, Bill.
I'll take a stab, Jim. First, my heart goes out to you and all the other small businesses that are slugging it out every day in the trenches. There is no update at the moment, but there is discussion in Congress about their limiting forgiveness. 150,000 and below can be, I think, automatically forgiven with a minimal amount of documentation requirement. Again, that's not approved. It's being deliberated in Congress, so we can have fingers crossed on that. Beyond that, I'm not aware of any updates other than the 2 options as far as the 8-week forgiveness period on the PPP loans or the 24-week. I know the EIDL loan had a grant, but I'm not aware that there is a forgiveness period or forgiveness at all for the EIDL loan, but I'm certainly open to being corrected by somebody who knows more about that than I do. Chris, do you have any thoughts on Jim's question?
Yeah, so certainly I can't speak to what's going on with Congress and the likelihood or the timing of when easier and expedited forgiveness application, whether that's through an affidavit. For loans currently, the figure that's being discussed is anything 150,000 or less. I can say that the Georgia Bankers Association, along with just about every state banking association that I'm aware of, signed a long letter. I know Senator Loeffler's office and Senator Perdue's office has a copy of that. Certainly banks are behind the effort. I think it's in the spirit of the way the law was written. This was meant to be a grant to companies. I think the fear that Congress needs to get over is there wants to be they want to utilize banks to ensure the money was used properly and it wasn't for fraud, which I believe was handled on the front end. There's a lot of documentation and a lot of information that was provided to lenders to establish the PPP loans to begin with. So I believe that the element for fraud was prevented. I also think, if somebody's going to fraud the U.S. government, they're probably going to do it for more than 150,000. They're going to go after larger loans, but that's just my context. I will say for us, for banks in general, and certainly for Renaissance, 150,000 or less represented 80% of our loans, but it was only 20% of our dollars. So, if that legislation comes to pass, it will really expedite the forgiveness process for lenders. It'll also ensure that we're focusing to ensure that the bulk of the money, 80% of the money, was used in the right way, in the way it was intended. So I certainly support it. I'm hopeful it's going to happen. In the meantime, I know Renaissance, along other banks, we have began accepting forgiveness applications. We're processing those. It's a little bit of a learning process for everybody in terms of our internal process, as well as just navigating through the SBA. As much as people and as much as businesses, and I completely get it. I've talked to a lot of my clients. They want this chapter closed. They want the loan forgiven. Remember, there's not necessarily a rush. Since payments won't begin for roughly 10 months after the loan was funded. There's not necessarily a deadline that's imminent. But certainly I do get, from a psychological standpoint, when I have the loan forgiven and off your books. I'm still hopeful that Congress will come in and provide that relief for us.
That's the questions that we have, but just to touch on it, all of the everything that Congress is looking at right now, I've been told, includes the 150 and under. So depending on which side of the aisle you're looking at for an answer on it, it should the 150s on both of their projected plans. And I've also been given a goalpost that they're hoping to have this passed by next Friday. They have moved the goalpost 4 times already, so good luck with holding me to that one. But just to give you a little bit of where they're at and what we're looking at. So that's the questions that we have. And again, if you do want an answer from the senator's office on that specifically, just send me a chat, and I'll make sure to add you to their email response. And let's get back to the program.
Great.
Going off the slide there. So I like this slide that Bill put together. Obviously bankers loan money. I've often heard it's when companies don't need it as well, and I completely get that. But I do like this question. Do you have a bank or do you have a banker? And I think we saw this become very important during the time of we were processing the PPP loans on the origination side. I think a lot of people do have a bank, but they don't necessarily have a relationship with a banker. And I would, if you don't have one now, if you're a small business owner, I would certainly encourage you to get to know certainly your tellers and the people you're interacting with on for daily transactions, but a branch manager, or if you feel like you have a lending need, a business banker or a commercial banker that may be in that office or may cover the territory for the branch that you visit. Getting to know a decision maker, or at least the decision influencer, I think ultimately will pay some dividends. There's also, I've been in banking since 1997. It's my only career, and I've heard this oftentimes from borrowers and from customers, and I can kind of see it both ways, from both the small business standpoint and from the lender standpoint. But I know a lot of businesses and a lot of business owners want to spread their banking business around, and they have their mortgage with one bank, and they have their personal checking account with another bank, and they have their business checking account with a third bank, and they have a loan from another bank. And I certainly understand the viewpoint of not having all your eggs in one basket. But the flip side is, if you do have a larger relationship with a single bank, oftentimes that is a really strong mitigant, having that relationship for the bank to make exceptions, to maybe look at loans in a different light, because you're providing value to them, and they want to reciprocate that. So something to think about as we kind of go through these months and years to come. And I think along with that relationship, hopefully comes trust and some chemistry that you build, so that when they do provide thoughts and ideas, you may come to them thinking you need a line of credit, but after some conversations and analysis, the banker may think you really don't need a line. This is permanent. You need a term loan, and hopefully that dialogue will kind of meet in the middle, and the decision that's mutually beneficial to both would be agreed upon. Sometimes a banker may offer an SBA option, and I know for a lot of small businesses, and maybe the PPP was their first opportunity to work with the SBA. Maybe they're a little bit sour on that. I completely get that, but I will tell you, the SBA and the Small Business Administration loans are really a foundation of business finance, and have been for a really long time. There's really nothing wrong with the SBA. Sometimes it can be the individual bank or banker that works with that. But when they offer that as a solution, I would just encourage you to keep an open mind, and have a conversation with the bank as to why they're recommending that. Yeah, Alex, I think the next slide.
So I'm going to ask permission to get on my soapbox a little bit here for our audience. So please bear with me. I'll come off very, very quickly. But if there were ever a time that there is good, solid financial management, it would be now. And it's more than just looking at the numbers on your page, but really understanding your leverage points. A couple of things. If you look at this slide, you're going to see that your balance sheet is more important than your income statement. So my soapbox is, if you're not looking at your balance sheet at least twice a month, you're really not paying attention as much as you should. The other thing I'll say is very little known, but there is a cash flow statement as part of your financial package that's available in QuickBooks. Cash flow statement tells you where your cash goes. If you're not looking at your cash flow statement at least monthly, please start. I have a client that I have worked with now for 10 years. His quote is, "It's all about the numbers," and I believe he's right. There's more to your financials than just numbers on the page. You really need to understand how to leverage your financials by making strategic decisions based on those leverage points. You get an annual checkup by your doctor, but when's the last time you put your business through one? Really, it's important to have, I think, a business checkup at least once a year. It often reveals symptoms in your business that have gone undetected, and you get a chance to deal with that before it becomes a real problem. So I'm off my soapbox now. Thank you for bearing with me. I'm going to hand over the next slide, Alex, and hand that over to Chris.
Yeah, thanks. So there are some basic ratios and certainly some things that that banks are going to immediately look at. And I will echo Bill's point regarding financials. For certainly for a banker, those are our X-rays. Those are the way we diagnose companies. You know, I understand that in this time of belt tightening and cost cutting, you know, that may be something that you want to move away from a bookkeeper, or you want to move away from your CPA, or you want to go from reviewed statements to compiled statements. You know, and I completely get the cost savings, but having current, accurate financials, if you want to come into a bank looking for a loan, is I can't emphasize how important they are. Certainly, once we get those financials, there's some things that our eyes are gonna automatically migrate to. Profitability certainly seems simple. If there was a loss last year, that's going to be hard for us as lenders to overcome. That's where we're going to need your help to help explain and look at things. Leverage, how much, you know, what is your debt to your worth? And I know for small businesses, that ratio can be a challenge because you're taking out distributions to help offset the taxes, and so you're not always building up that balance sheet. But I do think working with somebody like Bill, with your accountant, to have that conversation with, you know, where does my leverage point need to be? You know, I think in this time of tightening, you know, where ordinarily a 4-to-1 ratio may be satisfactory, I think we're going to see that lever down and maybe 3, 2.5, depending on what kind of industry that you're in and what the makeup of that balance sheet looks like, is probably where we're going to go in the near term. Obviously, you know, depending on profitability and a lot of other factors.
So part of this for banks, it is all about the risk. Banks, as Chris mentioned, are not going to lend into a loss. You need to understand that the economic uncertainty that we're in causes banks to tighten. I did a LinkedIn post recently that states that under preparation is actually killing your chances of getting a loan. The article that I cited said about 1 in 4 loans are getting approved. And primarily, the reason was business owners really weren't clear on their request. They didn't have a compelling case, or they didn't really have good command of their financials, specifically trends, and how your business has fared during COVID. Alex, let's go to the next slide. So really, it's important to understand that very early on, bankers tagged a little Post-it on their PJs that basically they went to sleep every night thinking of the 5 C's of credit. And we're going to talk a little bit about those later. But there was a day when I first started in banking in the late 70s, early 80s, where we did character loans. Oh, Joe's a good guy, or gosh, I've got this collateral, regardless of what the cash flow is, regardless of what the credit report is, regardless of what's going on in the economy, those kind of loans get done. Well, they're not getting done anymore. And so part of understanding is, you know, we're looking for cash flow, and we're also looking for a company that has a well-proportioned balance sheet. And by well-proportioned, I mean the debt is relatively low. Your creditors have slightly more skin in the game than you, but that gap, as Chris mentioned, is narrowing. Alex, let's go to the next slide.
Yeah, so Bill mentioned the 5 C's of credit, and I'm sure most people have heard these, but I do think it's worth going through, because I think it gives you a little bit of a insight into the mind of your banker, into the mind of a lender. As Bill said, I think in today's world, character needs to be a given. The challenge I think we have, particularly in a market like Atlanta, where there's new faces and new people, it's hard to judge character necessarily by doing business with your grandfather 20 years ago or whatever. So what we do look at is I think lenders generally think credit score is a reflection of character. If you have a checking account, have there been NSFs, have there been bounced or overrides that need to happen? I think that's going to kind of influence that. But then on the flip side, how long you've been in the industry, how long have you been in business? Can you provide references, both character references and I love bank trade references, who your suppliers are. I think that goes a long way. I think collateral and cash flow. There's, I've heard it explained to me. There's safe loans, and there are sound loans. And I think really what a good bank wants is they want safe and sound loans. So I think collateral, yeah, it's great that you got a great piece of collateral. Sometimes I think collateral is like beauty; it's in the eyes of the beholder. Because unfortunately, if the bank ever had to make good on that collateral, liquidate that collateral, we find out it's not worth what we thought it was. So what makes a loan sound? And I think that's cash flow, and I think that's credit. Really underwriting those, understanding those, how a loan's going to get repaid. Banks do not want to get repaid via collateral. We want to get repaid via cash flow, and maybe the conversion of that collateral in the cash flow. And the last one, conditions. Obviously, the world changed in February, March of 2020. We got this big overriding condition as the COVID pandemic. And I think what we're trying to assess is how resilient is your business and how resilient is your industry, and to maybe to a lesser extent, how resilient is the economy's impact on your business. And right now that's the big overriding conditions that we're having to look through. That's the new world lens that I think banks are having to evaluate things with. But I think if you could, before your conversation with the bank, maybe go through these 5 C's. And think how you would respond to each of them, and have that conversation and back and forth with your banker, because quite honestly, there may be something that they miss when you provide them financials, or you get a chance to tour your facility. Sometimes making that easier on them by going through those C's, maybe not explicitly, but so they can hear your story and put it in the context of those 5 C's. I think helps them go back to their credit committee or to their senior credit officer, and know that they've covered those bases and are making a strong recommendation in your favor. Alex, I think the next slide kind of builds on that a little bit, and it's kind of what to have in your bank presentation. And Bill touched on this a few minutes ago, but again, coming back to financials, and I know some people, we have those CEOs type personalities that maybe don't get into the weeds on financials. They leave that to their controller, their CFO. Which is fine, particularly if they're in the room and kind of speak to it. But having at least a, we're not going to ask you for debits and credits and to go through the journal entries, but certainly having a command of trends and what is happening in your business to impact certain aspects of those financials. That helps the bank with the diagnosis, certainly helps the banker have a better understanding of your company, so that when we go to present that request, we're going to speak intelligently about the business and be able to answer questions that may come up during our internal presentations. I think a clear request is very important, and that request can change. Oftentimes, what a business or what a business owner thinks they need, through some dialogue and through conversation, sometimes changes. But I think at the end of the day, knowing exactly what the funds are going to be utilized for, what the purpose of the loan is going to be for, and how that's going to benefit the company and in turn be repaid is vital. And then certainly the compelling case. As a bank, and we'll talk about this a little bit more. I mean, we're maybe making a 300 to 350 basis point spread. We're seeing margins shrink, and at those margins, it's hard to view ourselves necessarily as an investor in your company, but as a lender, we're certainly part of that. We're just not getting a return that some investors may get. So having a case as to why is this a good loan? Why is this a good investment in your company? Again, I think makes it a whole lot easier for your bank partner to work internally to ultimately get you what you're seeking and what you need in a favorable way. They're going to present these in some form or another, in a better understanding you're able to provide them with your company. I think the more successful the outcome will be.
And I think I'll just close and then we'll open it up again for Q&A. So please chat your questions in. When I referenced under preparation, killing your presentations, Chris did a great job of really explaining what the components of that is. And so if you're going to prepare, these are really the three things that we would suggest that you prepare for before going to see your banker. So let's stop the presentation, Alex, and then let's open it up again for Q&A. Any other questions from the audience that we can answer? Could be about bank presentations. We can peel the onion back a little further about how to prepare. We're going to talk shortly a little bit about the difference between bank financing and venture capital, but would love to answer any questions at this point.
So Alan just made a point and just I think he was just more defending the banks and says that most of these regulations are passed down to banks from the FDIC. So it's not the bank trying to be the bad guy in most of the situations. Chris, do you want to touch on that a little bit? So, but yeah, so if there's any questions about, I mean, it could even be if you're thinking about going into a bank in the next couple of weeks to ask for something, these guys are professionals at it. They can tell you how to dress, how to look, or even what documents to bring with you. So please, they're here for your help. So ask away.
Great. Well, why don't we, Alex, why don't we bring the rest of the presentation home, and then we can open it up again for one more time.
Perfect.
We talked about this a few minutes ago when Alan raised the question, and it is worth spending some more time on. One of the coolest things about my job, I love learning how, I love the business of business. I love learning how people make money. And, certainly there is an element sometimes of what I do. Certainly pre-pandemic, we got more of this. Was almost of the Shark Tank, which is a really cool show. A lot of times you see those business owners making a pitch, seeking equity. Sometimes they've already been through the bank, and I think there's a clear delineation between what constitutes a bank loan and what constitutes, we call it venture capital here, but I think that can be friends and family. I think that can be other means of raising capital. And I think the biggest thing, you know, as Alan kind of mentioned, yeah, we are a regulated industry. There are certainly internal loan policies as well as banking regs that we need to underwrite to, and generally there's not a whole lot of migration that we can take from those. But the big thing to remember, as I said before, I mean, banks are going to be lucky to make a 3.5% margin. That is a very small margin to take on risk. So when you look at that risk reward, that's why banks are making safe and sound loans. So, you know, we're going to have a lower interest rate. But the good news is we're not going to take any equity. We're not going to take an equity stake in the company. You know, so our return is in fact limited to whatever our interest rate is. It's not, we're not going to make money when you exit. We're not going to make money when the building sells. We're not going to make money on the upside. We're kind of locked in. So when you look at that risk reward, obviously banks are going to be at the lower end of the risk scale. Certainly if you're into a situation where maybe the company's newer, it's more of an idea and not necessarily a business, or if we're just lending into, you know, coming into a period of negative trends and some severe headwinds that a bank simply can't mitigate. With some of those 5 C's that we talked about, that probably does push the needle into, you know, whether it's venture capital, which I know can be expensive, particularly in the form of equity, you know, because they're going to participate in that upside. They're going to participate in that exit, and because they're taking on that higher risk, they're going to want a higher return. I'll put a hard money lender somewhat in that category. There'd be nuances on how they structure it, high interest rates, sometimes an equity component. I think those are going to be a little bit maybe less sophisticated, maybe on the smaller end than where you'll find venture capital. And then I'll put friends and family into that category. I know those are not comfortable situations to borrow from, but I've seen a lot of successful businesses do it for a short period at times. Sometimes there's equity, sometimes there's loans. Sometimes that's an easier conversation than others. And then I'll go down the route and also included with this, you know, other alternatives. Again, we talked about the SBA. You know, I think the SBA, you know, we talked about those 5 C's, that can be a mitigant if one of those C's are missing. You know, let's take character as a given, but maybe collateral isn't where it needs, you know, a bank would like it to be. Maybe, you know, maybe cash flow, the debt service coverage, the cash flow isn't as strong in 1 of the 3 years or 1 of the last 2 years. You know, an SBA guarantee can help mitigate that and help the bank get comfortable with providing a loan. You know, we talked about factoring. Again, that can be a higher, you know, more expensive financing option. But if you carry B2B receivables and you have, you know, maybe on a higher margin that you can withstand a little bit of that erosion, that can be a great solution. And, you know, the good thing about that is that can be a short-term solution that you work out of. And again, you don't have to give up any equity in your business. You know, all these sort of things have been deployed successfully by companies, certainly in times like this, and certainly even before the pandemic struck. I was amazed. One of the positive things I think that came out of the recession, you know, if we go back to 08, 09, 10, and whenever you define when it ended, what we saw was an abundance of equity. We saw an abundance of equity out there, primarily because banks aren't paying a whole lot in interest rates, so you're not going to get a good return. People are you know, scared maybe to put money into the stock market. So there was an abundance of equity coming into real estate transactions, being invested into companies. You know, to some degree, I don't think I don't think those future, and people are still scared of the stock market. So there is some equity dollars out there still. It may be a little bit more expensive than what it was in January of 2020 than it is in September of 2020. But I'm hopeful that some of those equity dollars across all boards are going to still be available to businesses, because it certainly, I know that helped us get out of the last recession quickly, and it kind of became a norm within a lot of lending circles. Hopefully that will continue and still be an option for companies in the months and years to come. Bill, I don't know if you have anything you want to add to this piece.
No, I think you did a great job. The only thing I would remind our audience is, banks aren't loaning their own money. They're loaning their depositors' money, our money. And so they do have a fiduciary responsibility to their depositors. And so a lot of things that fall outside of bank lending, there's just an understanding that banks have to make sure that they can not only provide deposits when needed, but also make loans as well. That would pretty much be it. I would like to make a few comments on the next slide if I can, Chris. Is that okay with you?
Sure.
So I'm going to take you through a very quick story because I know we're coming close to our time, but I was addressing the Southeast Accounting Show in the last recession, was talking about some of the items. I hope none of you have to go through this, but they say anxiety is the price you pay for the unprepared mind and mouth. So I want to talk about 3 terms and kind of tell you a story. So I was talking to the Southeast Accounting Show in one of their breakout sessions, and I was talking about forbearance agreements. A forbearance agreement is where your bank delays actually declaring a default, or excuse me, they declare a default, but they delay going into liquidation under mutually agreeable terms. And I had a CPA that raised her hand and said, I have a client that's about to sign one of those. So I just want you to understand a forbearance agreement from your standpoint is the bank has put you in default, but they're not going to move beyond the default based on executing a forbearance agreement. The other thing, this client that I was working with the CPA together on ended up in special assets. The special assets department, SAD, basically means you're sad if you're there because you have special risk assigned to your loan. And generally speaking, special assets is a place where banks put high-risk clients with the idea of trying to get the loan liquidated because there's specific risk. Usually you go into a forbearance agreement or you go into special assets primarily because you have a covenant default. In your commitment letter or in your loan agreement, there is likely mutual promises that you've made, primarily either due to cash flow, could be due to leverage. We talked about those things before. And if you've broken one of the covenants, technically the bank looks at that as you broke your promise to the bank, and they have the right to declare a default. So I hope you never experience any of these terms, but these were fairly prevalent in the last recession. I think because the economy is a little uncertain, we don't know if these terms are going to come into play, but both Chris and I wanted to be sure that you were at least familiar with these terms in case they came up in your situation. Hopefully they never will. Chris, anything to add to that?
Yeah, no, you did a great job explaining and providing some narrative with firsthand experience with that. We felt it was important to include this slide for a couple of reasons. One, certainly, if you're not familiar with these terms, if you hear them to have your antenna up. This is specifically for businesses that have banking relationships. I will say there's a number of banks I know that utilized forbearance agreements to help handle deferments. I don't know that that was the proper use necessarily from a personal standpoint, because it was kind of a mutually agreed upon between the bank and the borrower for a deferment for a period of time. If there's a second deferment, I wouldn't be surprised if it's common at that point maybe to utilize a forbearance agreement. Sometimes that's when the attorneys get involved. But what I would encourage you to do is really two things. One, if if your antenna goes up and you start hearing these terms, is to encourage and reach out for an open and honest conversation with your banker. Certainly if the bank is looking to exit the relationship, these terms are going to be utilized. I would definitely say you need to start looking for other options, lending, venture capital, whatever those roads need to be. But also maybe going back to that slide that we talked about to make sure that, does your lender have current financials? Or do you have a command of those financials? Are you going to explain how you're going to operate in this environment and eventually get back into compliance with whatever covenant, whatever trigger is being utilized by the bank to kind of make this move into special assets or a forbearance agreement? It's an opportunity, perhaps, for the bank to re-underwrite the loan with a more current view of your company, and hopefully work together with a solution. Sometimes that happens, sometimes it doesn't, but it is an opportunity to kind of go back to kind of stage one on how you get that loan to begin with. Make sure your banker has current financials, make sure you have an understanding, he or she has an understanding of those financials, and how you've been able to articulate the plan on how, really how to get back into a profitable, compliant status.
Alex, next slide. So this is kind of trying to put it all together. Again, we're a little bit over time, so I do want to say thank you to Alex Forsyth of Forsyth County for allowing Chris and I to talk. But your guide, whether it's your banker, whether it's your CPA, whether it's an attorney or a business advisor like me, your guide not only is a guide, but it's a guide with a plan, and this is really what the plan should entail. And as Chris mentioned, talking to your banker when you need to obtain financing, and again, paying attention now more than ever, staying on top of your numbers, and not only just staying on top of your numbers, but understanding the leverage points of your numbers so that you can maintain good cash flow and good profitability. Chris, anything to add here?
No, I think that kind of summarizes everything really well. I do think communication is critical, and having, hopefully not a 1-800 number, but somebody you can call and talk to is really vital. I think your banks, probably your first line of defense, they're there, they want to help. They want to help their customers. Sometimes they're going to need your help to help you with some of those items that we talked about, just, current financials, having an understanding, having a narrative that you've kind of prepared. You don't necessarily need a full business plan. You don't need to come into the bank with a spiral bound notebook with glossy pictures. Sometimes, my saying is the prettier the package, the worse the credit. You don't necessarily have to do that, but certainly having financials, having a conversation and a discussion to make sure that your banker understands your business, understands what you need, is going to be a really good place to start.
Yeah, so
I think I
again,
saw Alan putting on his former banker hat there, adding, now's the time to run to your bank and not away from them. That's a great comment, Alan. I appreciate you sending that.
I'm gonna just make a quick shout out here to Bill and to Chris. Thank you again for taking the time out of your day to put this presentation together. If anybody participating in the call would like to get in touch with either Bill or Chris, their contact information is on the screen now. I'm gonna stop sharing the presentation in just a second after you can write down all their information. But also this presentation has been recorded, and I'm going to send it to everyone that had registered for the presentation as well. So if you know of a small business that could utilize this webinar, please feel free to share it with as many people as possible. We don't have any sort of rights to it. We just put it together to help all small businesses. So again, thank you to Bill and to Chris. And let's get to our last session of Q&A. And we have a whole lot of thank yous and not a whole lot of questions. So if anyone has a specific question for Bill or for Chris, please let me know. And if you do not and you would like to ask them in private, again, I can reshare their contact information. Just let me know and I will get it sent over to you.
Just want to say thanks again to our audience, Alex. Chris and I together wanted to provide something that was meaningful, had value. Hopefully the sign of no questions at the end is we got the important questions answered, but I know it was all three of our hope that we gave a couple of really good takeaways to our audience today.
Yeah, Alex, thank you again for putting this together. I really applaud the chamber and everything y'all have been doing for really since day one when the pandemic started, and providing, I think, relative content and guidance to small businesses. Y'all are doing it like nobody else is that I've seen, and really something to be commended on.
Well, thank you. And thank you, Chris, and thank you, Bill, and thank you again to all the small businesses for participating. And like Chris just touched on, we're trying to do whatever we can to help any business survive this. So if there's a topic that's affecting your business and you would like for me to find an expert to bring in to try and get you some answers, let me know, and we'll do whatever we can to help you in any way possible. Thank you again to Bill and Chris, and thank you for joining us, and we'll see you guys on the next webinar.
Have a great day, everybody.
All right.